Stop what you're doing. They just activated the kill switch. $4.2 trillion in leveraged positions about to get liquidated. Dollar yen broke 144.73 at 3:17 a.m. Tokyo time. If you're holding silver on margin, you have hours before forced selling begins. This is not a drill. This is not market volatility. This is financial warfare, and every precious metals position holder is about to become collateral damage in the biggest margin call cascade in financial history. Right now, as I'm recording this emergency broadcast, silver is trading at 113s on your COMEX screen. That's the paper price, the price they want you to see. But here's what they don't want you to know. In Shanghai, physical silver is trading at $127 per ounce. In Tokyo, 134s. In Dubai, 129s. There's a $14 to $21 gap between what real silver costs around the world and what the paper market says. That gap just became a kill zone. And if you don't understand what just happened in the currency markets at 3:17 a.m., you're about to become exit liquidity for the biggest banks on Wall Street. Ladies and gentlemen, this is Alex Chen from Crisis Intelligence Network. It is Wednesday, January 29th, 2026, 11:43 a.m. Eastern, and I just received confirmation from 3 different institutional sources that the Japanese carry trade system is experiencing catastrophic failure. The Bank of Japan blinked. The dollar-yen carry trade that funded $4.2 trillion in global leverage just broke at the worst possible technical level, and precious metals holders, you're about to pay the price. Welcome to Crisis Intelligence Network. If you want to understand what the institutions see before they move, subscribe immediately. What I'm about to show you could save your portfolio from total destruction. Let me start with the document they don't want you to see. Bank of Japan intervention data from 3:17 a.m. Tokyo time. Dollar yen touched 144.73 and bounced to 144.91. For those who don't understand Forex, that 18 pip bounce was the BOJ trying to defend the 145 level. But here's what my Tokyo source just confirmed. They failed. The intervention lasted exactly 7 minutes. 7 minutes of artificial buying to prop up the dollar against the yen. Then it collapsed. We're now trading at 144.39 and falling fast. Every tick lower represents billions in carry trade losses being realized in real time. Why does this matter for your silver positions? Because the carry trade funded everything. For 15 years, every major hedge fund, pension fund, and investment bank has been borrowing yen at 0% interest, converting to dollars, and buying higher-yielding assets. Treasury bonds at 4%, corporate debt at 6%, real estate at 8%, and yes, leveraged precious metals positions. That trade just died at 144.73. Here's the mathematical reality they can't hide. When dollar yen moves against carry traders, it's not a 1.1 loss. These positions are leveraged 10.1, 15.1, some even 20.1. A 3% move in the currency becomes a 30% to 60% loss on the leveraged position. And we're not looking at 3%. We're potentially looking at a 15% to 20% dollar collapse against the yen over the next 30 days. My source at a major investment bank just confirmed their risk management systems are flashing red across every dashboard. They're looking at potential losses that could wipe out 2 years of profits in the next 48 hours. And they're not alone. Every institution that borrowed yen to fund U.S. investments is staring at the same mathematical nightmare. And when the margin calls come, and they're coming, they don't sell what they want to sell. They sell what they can sell. They sell liquid assets. They sell precious metals. They sell your positions to cover their currency losses. But here's where it gets personal for metals holders. The same banks getting destroyed on carry trades are the ones who've been manipulating silver prices for decades. JP Morgan with their $920 million manipulation fine, Goldman Sachs with their commodity desks, Bank of America with their massive short positions. These banks are about to get margin called on $4.2 trillion in carry trades. And their solution? Crush the metals markets to cover their losses. Liquidate every long position they can touch. Force selling in silver to raise cash for yen purchases. This is 1980 all over again. Same playbook, different crisis. Let me show you the proof. COMEX delivery data from January 27th just released. This document confirms everything I've been tracking. January 2026 is now the 7th largest silver delivery month in COMEX history. But here's the insane part. January isn't even a primary delivery month. Primary months are March, May, July, September, December. January is supposed to be quiet. Nobody demands delivery in January. But traders are demanding physical silver right now. 11,147 contracts delivered so far, with 3 trading days remaining. Look at who's issuing delivery notices. JP Morgan Securities. 423 contracts issued yesterday alone. That's 2.1 million ounces of silver they delivered in a single day. Why would JP Morgan suddenly start delivering massive amounts of physical silver? Because they're covering their shorts before the carry trade liquidation hits. They know what's coming. They're positioning before the storm. But here's what should terrify every silver holder. While COMEX registered inventory sits at just 47.2 million ounces, down 73% since 2020, the paper-to-physical ratio has exploded to 394.1. That means for every ounce of physical silver that actually exists, there are 394 paper claims, 394 people who think they own silver. Only one of them actually does. When the carry trade unwind accelerates, when institutions need to raise dollars fast to buy yen, guess what happens to those 394 paper claims? They get liquidated, all at once, in a cascading waterfall of forced selling that will make today look like a gentle correction. Now let me show you what's happening in physical markets around the world, because this is where the real story is hiding. Shanghai silver, $127 per ounce. Tokyo silver, $134 per ounce. Dubai silver, $129 per ounce. Mumbai silver, $125 per ounce. COMEX paper silver, $113 per ounce. This isn't a market. This is a confession. People who actually want physical silver, real metal they can hold, are paying 12% to 19% premiums over the paper price. In some cases, they can't get metal at any price. My Dubai contact tells me 10-kilogram bars have a 4-week delivery delay. 4 weeks for silver that's supposedly trading at $113. Why would anyone pay $134 for silver in Tokyo when the screen says $113? Because they don't trust the paper anymore. Because they've figured out the game. Because they know the COMEX price is fiction. This is what market structure breakdown looks like in real time. The great divorce between paper promises and physical reality. And when the carry trade liquidation hits, when $4.2 trillion in leverage starts unwinding, the divorce becomes permanent. But here's the part that should keep you awake tonight. Silver lease rates just spiked to 11.7%. Let me explain what that means. A lease rate is the cost to borrow physical silver. Normally, these rates sit around 0.5% to 1%. 11.7% is panic territory. When lease rates spike like this, it means someone is desperate enough to pay 11.7% annually just to get their hands on silver. That only happens during severe physical shortages. The silver market is also in extreme backwardation. Spot prices are trading higher than futures prices. That signals immediate demand is overwhelming forward supply. These are technical signals that scream shortage, and they're all flashing red simultaneously. Now let me tell you about the kill switch they just activated. At 2:15 p.m. Eastern yesterday, the CME Group announced new margin requirements for silver futures, effective February 1st. The maintenance margin is now $63,400 per contract. That's a 47% margin requirement. 3 weeks ago, that margin was $28,000. They've more than doubled the cost of holding a silver position while the carry trade crisis unfolds. This isn't risk management. This is systematic elimination of retail participation while institutions liquidate. Here's how the kill switch works. A standard COMEX silver contract represents 5,000 ounces. At $113 per ounce, that contract controls $565,000 worth of silver. With a $63,400 margin requirement, you need 11.2% of the total value in cash just to hold the position. Compare this to stocks. Most brokers let you trade with 50% margin. Some futures contracts have 3% to 5% margins. But silver? They want 11.2%. And they raised it there in 3 weeks while the biggest financial crisis since 2008 unfolds in currency markets. Why? Because at lower margins, regular people could participate. They could hold positions through volatility. They could ride out the manipulation. At $63,400, regular people are priced out. Only institutions can play. But here's the mathematical trap they built. As of January 15th, COMEX moved to percentage-based margins. Silver is now at 11.2% of contract value. What does that mean? Every time silver goes up, the margin requirement goes up automatically. The higher silver climbs, the more cash you need to hold the same position. In a bull market, this is designed to force liquidation. Most traders can't keep posting additional margin as prices rise. They get forced out precisely when they should be winning. This is financial engineering designed to transfer wealth from retail traders to institutions during crisis periods. And right now, we're in the biggest crisis since the 2008 financial meltdown. Let me show you the carry trade mathematics that's driving this. The Bank for International Settlements estimates $4.2 trillion in outstanding yen carry trades globally, about $2.1 trillion held by U.S. institutions. When these positions unwind, institutions must buy yen and sell dollars to close trades. But here's the leverage multiplier. These aren't 1.1 trades. Average leverage on carry trades runs 12.1 to 15.1. A 5% move in dollar yen becomes a 60% to 75% loss on leveraged positions. We've already seen a 4.2% move. If we get to 140 yen per dollar, and technical analysis suggests that's probable, we're looking at a 10% currency move. 10% currency move x 15.1 leverage, 150% loss on carry trade positions. That's not a loss. That's total wipeout with additional margin calls on top. When institutions face losses of this magnitude, they don't sell what they want to sell. They sell what they must sell: liquid assets, precious metals, whatever generates cash fastest to meet margin requirements. Your silver positions become their emergency exit liquidity. Now let me show you something that proves the panic is already starting. Gold lease rates spiked to 2.7% yesterday. That's the highest level since March 2020. Silver lease rates, as I mentioned, hit 11.7%. Both metals are trading in backwardation. These are screaming shortage signals. But here's the contradiction that exposes the manipulation. While lease rates spike and physical premiums explode worldwide, COMEX paper prices are getting hammered. Silver down 4.7% today alone. This is mathematically impossible in a legitimate market. When physical demand overwhelms supply, prices should rise. When lease rates spike to panic levels, prices should rise. When inventories drain at record pace, prices should rise. Instead, paper prices fall while physical premiums explode. This is the signature of massive short selling by institutions that need cash immediately. They're selling paper silver, they don't have to raise dollars for yen purchases. The paper price crashes while physical becomes unavailable at any price. This exact pattern preceded every major precious metals bull market in history: 1971, 1979, 2001, 2008. Paper manipulation reaches extremes, physical demand overwhelms supply, then price discovery shifts to physical markets. We're watching that transition happen in real time. Here's my source data from 3 major precious metals dealers. APMEX, Silver Eagles showing 2 to 3-week delays. JM Bullion, 1,000-ounce bars, unavailable. SD Bullion, premiums increased 23% in 48 hours. These aren't normal market conditions. These are shortage conditions while paper prices fall. The great divorce between paper and physical is accelerating. Let me give you 3 scenarios for what happens next, because I know you want specifics. Scenario 1, controlled demolition. The Fed intervenes with massive dollar support. Carry trades get backstopped with emergency liquidity. The crisis gets postponed, not solved. Silver consolidates between $105 and $125 for 3 to 6 months, while physical premiums persist. Then the real rally begins when the underlying problems resurface. Scenario 2, cascade liquidation. Carry trade losses accelerate. Major financial institutions face severe stress. Emergency selling hits all risk assets simultaneously. Silver drops to $95, $85 on paper while physical premiums explode to $40, $50 above spot. The two-tier market becomes permanent. Scenario 3, system break. The carry trade unwind overwhelms central bank intervention. Currency markets lose all stability. Flight to hard assets accelerates. Silver breaks $150 within 60 days as paper markets become irrelevant. Physical silver trades at massive premiums to any remaining paper quotes. Based on the speed of recent developments and the mathematical certainty of carry trade losses, I assign these probabilities. Scenario 1, 25%. Scenario 2, 45%. Scenario 3, 30%. Any of these scenarios reward physical holders and punish paper traders. Now let me address the 3 types of people watching this. First type, you already hold physical silver. You've been stacking for years. You're profitable but scared they'll manipulate it down again. To you I say, don't let them shake you out. Physical silver doesn't get margin called. Physical silver doesn't care what COMEX says. Hold through the paper manipulation. Second type, you're curious about silver but don't own any yet. You've seen the headlines but haven't acted. To you I say, understand the difference between paper and physical. Paper gets manipulated. Physical gets scarce. Choose accordingly. Third type, you think this sounds like conspiracy nonsense. You trust the system. To you I say, look at the data with me, look at the lease rates, the delivery numbers, the global premiums, then make your own decision. Here's what I'm personally doing, and this is not financial advice. I'm not selling any physical silver. I'm holding through volatility. On significant paper price drops, I'm adding small amounts, money I can afford to lose completely. I'm not trading futures. I'm not playing the margin game. I'm holding metal that no margin hike can take away. That's my strategy. Yours should fit your circumstances and risk tolerance. Could silver crash from here? Yes. In 1980, after hitting $50, silver fell 90%. It took decades to recover. Could the manipulation continue? Yes. They have more tools now than ever. Could I be completely wrong? Absolutely. I've been wrong before. But here's what I know for certain. The carry trade crisis is real. The margin hikes are desperate moves. The physical shortages are mathematical reality. And when systems break, wealth transfers from those who don't see it coming to those who do. The $4.2 trillion carry trade bomb just detonated. Your metals positions are trapped between paper manipulation and physical reality. The question is which side of that divide you choose to be on. Physical silver sits in your safe and doesn't care about margin calls. Physical silver doesn't get liquidated when institutions need cash. Physical silver is real money when paper promises fail. This is Alex Chen. The carry trade is unwinding. The margin trap is set. And you have hours, not days, to decide which game you want to play. The mathematics don't lie. The institutions are panicking. And the biggest wealth transfer in precious metals history is about to begin. Screenshot this video. Save these numbers. Come back in 30 days and see who was right. Here's the smoking gun that proves coordination. Yesterday, simultaneously with the BOJ intervention failure, 3 major banks issued bearish silver research within a 4-hour window. Goldman Sachs, Morgan Stanley, Credit Suisse all published negative calls the same day. Carry trades exploded. That's not coincidence. That's market manipulation executed in real time, but their models didn't account for Asian physical demand exploding. Shanghai reports 47-ton daily transactions, triple normal volume. Beijing accumulates physical metal while Western banks manipulate paper prices lower. This is wealth transfer from west to east in real time. While Americans get trapped by margin hikes, Asian buyers accumulate physical silver at artificial prices. Technical analysis confirms the breakdown. Silver broke the 50-day moving average at $116.73. Next support at $109.20. If selling accelerates, we could test $95, the October breakout level. But every paper breakdown comes with expanding physical premiums. Lower paper goes, higher premiums spike. This confirms the 2-tier market is permanent. Professional traders call this basis blowout, when futures divorce from physical reality. Happened in oil during COVID, natural gas during European crisis, now silver during carry trade collapse. Once basis blows out, it never reverts. Paper markets lose credibility permanently. Price discovery shifts to physical. Paper holders get destroyed. March 2020 precedent. Oil futures went negative while physical cost $20. Paper traders lost everything. Physical owners made fortunes. Same mechanics, different commodity. Here's the insider intelligence. 3 major hedge funds accumulated 847 million ounces of physical silver September-December 2025. Not futures, not ETFs, physical metal in private vaults outside banking system. They positioned before the break. They're holding physical while paper traders get liquidated. Critical dates, February 15th, COMEX options. Expiration, February 28th. Japanese fiscal year-end requiring carry trade completion. Between now and February 28th, maximum selling pressure. After that, forced liquidation ends. Real rally begins. But here's what most people miss completely. The institutions creating this crisis are also positioning for the recovery. While they force retail liquidation through margin hikes, they're accumulating physical silver through back-channel dealers. This is the oldest play in their book. Create the crisis, profit from the panic, accumulate at distressed prices, then profit again from the recovery. Don't let them shake you out at the bottom. Physical silver doesn't get margin called. Physical silver doesn't care what COMEX says. Physical silver is real money when paper promises fail. Mark those dates. Screenshot this analysis. Come back in 30 days and see if the timeline played out exactly as described. Remember the numbers that matter. Dollar-yen at 144.39 and falling. Silver lease rates at 11.7%. Physical premiums $14.21 above paper. COMEX inventory at 47.2 million ounces, down 73% since 2020. These numbers tell the real story while paper prices lie. The crisis is executing right now, and you need to decide which side you're on before Asian markets open tomorrow. Subscribe for live crisis updates as this unfolds. Share this with anyone still trusting paper markets. And remember, when systems break, wealth transfers to those who saw it coming. This is Alex Chen. The carry trade bomb just exploded. Your metals are trapped between paper lies and physical reality. Choose wisely.